Marcus was just telling us about yields rising and how that could pressure EM bonds. Take a look at this chart on the Bloomberg, because we're seeing the 10-year real yield, the inflation-protected rate, climbing to a 14-year high. That's really leading to more demand for the U.S. dollar. Can local bonds in emerging markets ride out this short-term volatility?
Terry, thanks for having me. Indeed, it's a very unusual circumstance, even looking back a few decades, to have the Fed embarking on such an aggressive hiking cycle, real rates going up so much, and EM holding up so well. So this is really something quite different and reflects the good fundamentals and the preparedness in which emerging markets have come into this rate hiking cycle. Many of them hiked before the Fed, and their economies were not plagued by an excess surge of foreign capital, which didn't come in the last 10 years. EM has not been a favorite destinations on the bond side for at least a decade. And so it's not as though it's a crowded market where people are trying to exit. It's more one that investors are seeing this lower correlation that you showed very clearly earlier on, and that Marcus mentioned in terms of specific fundamentals by country.
But economic fundamentals, say in China, so important in emerging markets, has been really tough at the moment. We saw the Chinese yuan fall to that November low against the U.S. dollar. Is that a headwind for EMs, or could there be some more opportunities in Chinese government bonds?
Well, indeed. I mean, for emerging markets, the U.S. and Europe are one side of the story, very important in terms of global growth. But China is a major client for most emerging market countries, and a slowdown in China is a risk, is a headwind. I absolutely agree. In terms of opportunities, what that will do is reduce the threat of higher global inflation. China is actually exporting deflation, which is something positive for global bondholders who've been really worried about inflation until now. And that is definitely an opportunity for EM as well.
Yeah, how long do you see this deflationary environment in China lasting for? And is the current policy response that we're seeing going to be enough to address it?
Well, the deflationary story I think it will be a minor one. We're not going to go into a major deflationary cycle in China. There is excess supply because a lot of the support during the waves of COVID were more on the supply side than the consumption side, unlike in the US and in Europe, where consumers were helped a lot. So that lack of demand is reflected in the fact that China is exporting more, and its currency is weaker, its inflation is slightly negative as well. That can last for a little while until domestic demand recovers, until confidence is rebuilt among entrepreneurs to invest again. And that's what's lacking so far. So unless we need to see some policy action from the Chinese side to restore that confidence, and until we see that, this situation can persist.